Hey everyone, welcome back to Corporate Decoder. Today, Texas Community Bancshares Incorporated TCBS filed its 11K report for the fiscal year ended the 31st of December 2025, and I am seeing some interesting financial signals. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details the financial health of the Broad Street Bank SSB 401k profit sharing plan, and it gives us a glimpse into how the company is managing its employee benefits and investments. Let's dive into the numbers to understand what they might mean for Texas Community Bancshares Incorporated. So, what exactly is this filing? It is an annual report for an employee benefit plan, specifically the Broad Street Bank SSB 401k profit sharing plan. Texas Community Bancshares Incorporated is the issuer of the securities held within this plan, and its principal executive office is located in Minola, Texas. The key takeaway here is that this document focuses on the financial performance and compliance of the employee savings plan, not the direct financial statements of the parent company, Texas Community Bancshares Incorporated. However, the way this plan is managed can indirectly reflect on the company's overall financial health and its commitment to its employees. Now for the juicy part, the money, looking at the plan's financial information for the year ended the 31st of December 2025, we see some pretty significant numbers. The total plan assets started the year at a hefty $7,707,350. That is a substantial amount of money set aside for employees. By the end of the year, those plan assets had decreased to $6,264,836. This is a drop of about $1.4 million, or roughly 18%. This kind of decrease could be due to a few things. It might reflect market downturns affecting the value of the investments within the plan. Or it could be due to a higher volume of withdrawals and distributions by employees during the year. Without more context, it is hard to say precisely why, but a nearly 20% reduction in total assets is definitely something to note. Let's break down where the money came from and where it went. Contributions from employers, which is Texas Community Bancshares Incorporated in this case, amounted to $192,322. This represents the company's direct contributions to the plan to help its employees save for retirement. Participants, meaning the employees themselves, contributed $264,070. This shows the employees are actively saving from their own paychecks. It's good to see employees actively participating and contributing their own money. There were also other contributions, including rollovers, totaling $110,245. Rollovers typically come from previous retirement accounts, allowing employees to consolidate their savings. The plan also generated other income of $947,526. This could be from investment earnings, dividends, or interest. This is a significant chunk of income for the plan, suggesting the investments within the plan are actively generating returns. When we add all these pieces up, the total income for the plan for the year was $1,514,163. This is the gross amount that came into the plan from all sources. Now let's look at the outflow. Benefits paid out to participants, which includes distributions and direct rollovers, amounted to a substantial $2,941,489. This is a very large number compared to the total income. There were also administrative expenses, payments for services like record keeping and investment management, and other professional fees totaled $15,188. This is a relatively small amount compared to the benefits paid out, which is generally a good sign. So the total expenses for the plan were $2,956,677. When we compare that to the total income of $1,514,163, we see a net loss for the plan during the year. Indeed, the net result for the plan year was a loss of $1,442,514. This directly corresponds to the decrease we saw in total plan assets. This loss is primarily driven by the high amount of benefits paid out exceeding the total income generated. This outflow of benefits is significantly larger than the contributions received and the investment income earned. Let's look at the types of assets held within the plan. The plan held $2,221,505 in employer securities. This means a significant portion of the plan's assets are invested in the stock of Texas Community Bancshares Incorporated itself. This can be a double-edged sword. If the company does well, the employees benefit from their stock holdings. However, it also concentrates risk. If Texas Community Bancshares Incorporated underperforms, the employees' retirement savings take a direct hit, in addition to their job security. The plan also has $65,506 in outstanding participant loans. These are loans taken out by employees against their retirement savings. While often seen as a benefit, these loans can also hinder long-term retirement growth if not repaid diligently. Now, let's move to compliance. This section asks important questions about how the plan is managed. The plan checked no for most of the critical compliance questions, indicating no major issues faced during the year concerning failed loan repayments, lease defaults, or non-exempt transactions with parties in interest. This is a positive sign for the plan's governance. However, there is a yes for question 4A. Was there a failure to transmit to the plan any participant contributions within the time period described in 29 CFR 2510.3 -102? This is a critical compliance point. It means that at some point during the year, participant contributions were not sent to the plan on time. While it says continue to answer yes for any prior year failures until fully corrected, the fact that it is marked yes for the current year suggests there was a delay or issue in getting employee money from payroll into the retirement plan. This is something the Department of Labor takes very seriously. For a company like Texas Community Bancshares Incorporated, this could potentially lead to penalties or require a formal correction program. It suggests a potential breakdown in internal processes related to payroll and benefits administration. On a more positive note, the plan was covered by a fidelity bond, and the amount was $500,000. A fidelity bond is like insurance for the plan, protecting participants from losses due to fraud or dishonesty by those managing the plan. Having this coverage is a standard requirement and a good sign of responsible plan management. The plan also indicated yes to question 4I. Did the plan at any time hold 20% or more of its assets in any single security, debt, mortgage, parcel of real estate, or partnership joint venture inst? This points to a potential concentration of assets. While not inherently bad, holding such a large portion of assets in a single investment type can increase risk. Given that we saw a significant amount in employer securities, this question might be related to that. Over-concentration in any one area can amplify losses if that specific investment falters. Looking at the very end of the filing question 5, A asks if a resolution to terminate the plan was adopted. The answer is a clear no, meaning the plan is intended to continue operating. Overall, this filing gives us a look at the Broad Street Bank SSB 401k profit sharing plan for Texas Community Bancshares Incorporated. We see a decrease in plan assets for the year, largely driven by benefit payouts exceeding income. There is also a notable issue flagged regarding the timely transmission of participant contributions, which warrants closer attention. The significant investment in employer securities also highlights a concentration of risk for plan participants. The recent news about Texas Community Bancshares Incorporated increasing